Welcome to the Dividend Talk podcast, episode 25, Siemens AG Stock Review. Hey guys, welcome back to another episode of Dividend Talk. I'm your co-host, Engineer My Freedom, and today I'm joined with European DGI. This is a podcast where we discuss our passion for dividend growth investing with our own unique European flavour. If you're new to our channel, please hit the like button and subscribe to us, and check out our previous episodes on YouTube and Spotify. See you on the inside. Welcome back, guys, to another episode. I'm joined, as always, by European DGI. How are you going?
Really good. It's been a really great week. I've been working, of course, really hard, but I think we have a really interesting topic today because Siemens is a great company with, I actually don't know a company with a larger history, which is still listed than Siemens in the European stock market. So I'm really, really looking forward for this one.
Yeah, it's a really, I suppose we really picked this one because they've cut their dividend recently, so it's going to be a good one to talk about. But we'll get into that in a little bit. We've got plenty of time. So how's things on your end? Is there anything from the news that you want to speak about today?
Well, I think it's needless to say, I wrote in it also in my blog post, 5 Bullet Sunday last Sunday. But it's, of course, the transition from Unilever dual listing into full move towards London with its headquarters. And yeah, once again, this is for me. You know, I look always a little bit at European companies like a librarian or a historian. And I find it so unique that this company now is not dual listed anymore. It has protected itself with that through good and bad times, specifically the bad times. And I mentioned more often that the CEO in England, in Britain, during the Second World War, they couldn't even communicate with Unilever in Amsterdam. They didn't get response for 4 or 5 years. They didn't know whether the dividends were announced at the time. I find this so unique, and yeah, we'll see what it brings. Interesting thing is that also with Phil Sackler, we were talking a little bit about what does this really mean, for the dividends now. So, as an investor personally, I'm not too happy because I'm on the I'm on the side where I was having my shares in euros. So it's now being listed in London. So the main share is based in the Great British Pound. So if their dividend track record is now going to be in pounds, which that means that I get an additional risk in currency fluctuations that I didn't ask for. So that's the only thing that I'm really not too happy with. Many people ask me, like, what am I doing? So I'm keeping my stocks on the Amsterdam Stock Exchange just because it is easier from my broker point of view that I have them. I don't want to sell my position as well. I've got quite a large position in it. So I just keep on accumulating in the Amsterdam shares, and I'll just have to take the currency headwinds potentially and on the chin, like it would be if I would have other companies from the UK. And yeah, I actually bought 35 shares more because the stock dropped quite a bit this week with almost 10%. And one of my followers mentioned that it's probably because funds need to, sell them off and buy the UK version or something like that. So it gave if this is the technical reason, that's a great opportunity to buy for us as stock investors.
Do they not know that most companies are trying to get out of Great Britain at the moment with Brexit, and they've gone the other way?
Yeah, I think it is to do with the tax laws. I think it's more attractive for Unilever to be listed in the UK from a tax point of view. There was quite a political battle in the Netherlands. There's still like a potential 2 or 3 billion fine going towards Unilever for pulling out of the Dutch stock exchange, and then let's say out of the Netherlands. So the the Dutch government has the opinion if such large companies are going away for tax evasion reasons or something like that, that it should end up with a fine as well. So potentially they will still get a 3 billion fine, or 2 or 3 billion fine from the Dutch government for this reason.
Well, from my own point of view, I believe I am charged an additional 1% on UK stocks as stamp duty. So I need to actually look into that. I might make a note of that for this week just to be sure what effects it'll have on me. But it's interesting with the fines. It's not really tax evasion. They'll still be paying tax. They're just moving their moving their base to the UK. So I don't see why they should pay that fine. But hey, the Netherlands need to get their money, don't they?
I mean, tax evasion, tax cleverness, I don't care how they call it, actually. It's just a Dutch perspective on that, I guess. And how about yourself? Did anything caught your attention this week in the news?
Yeah, something caught my attention, and it's really because of you. We all know you like Tequila on this. So Dwayne Johnson, I don't know if you ever watched WWE or wrestling. Dwayne Johnson's The Rock, one of the
Yeah.
He's
I know him from Jumanji 2.
Yes. So as a kid, I used to watch wrestling, and he would have been one of the main wrestlers. And I'm not going to put off an impersonation of him, but he was pretty cool at the time. But he has his own brand of tequila now that's doing pretty well. Released it in the middle of a pandemic. Who like releases alcohol brand in the middle of a pandemic? But by all accounts, it's absolutely flying out, and it's doing really well. So one to watch out for. And if they ever do an IPO, it might be one to look at. But it only caught my eye, as I said, because you're a fan of tequila, and it might be one that you might want to try and see what it's like.
Honestly, I think it's quite clever, because what do you else do when you're alone at home? Okay, guys, this is not advice, of course. But that's very interesting. So once it is available here, we'll definitely give it a try, because who doesn't want to drink something from the rock? Maybe I get these kind of superpowers. And the Jumanji, it was really interesting. I think they could throw nuts or something at him, and with his nipples he could bounce them back. So that was my kids love this scene in Jumanji. So if you have kids around 6-7 years old, show them Jumanji 2, because then they will see the rock and they will love it. But something else that I found really interesting is the run up lately in oil stocks, energy stocks. So if I look at my own portfolio, Chevron, ExxonMobil, Shell, wow, 50% gains from their bottom. And I just wanted to ask you, what did it do to your portfolio? Because my portfolio is for the first time of the year coming in green again, because mine was really in red due to the oil stocks. And I was just wondering how your portfolio looks like after this bounce back from the energy sector.
Yeah, I haven't actually checked it this week at all. Actually, I typically don't like to check every single week. But I do remember last week, I've been green for a couple of months now. Well, not a couple of months, a couple of weeks at least. And Shell had a lot to do with that. Remember, they bounced 5 or 6%, and I think they're my largest position at the moment. So I'm pretty sure that if I check it now, I'd see a nice green figure there at the moment. I'm happy. As I said, I still would like to buy a little bit more when they were cheaper. But everyone, that's just being greedy. As I said to you off air, I'm selling puts at the moment. So if they do drop back down, I'm happy to own them. But if not, I'll just keep collecting premiums. But no, it's great. It's good to see, and it's good. I know oil had a heavy impact on your portfolio and maybe others. So starting to see that bounce back will have a big difference to portfolios. My only concern is someone like ExxonMobil that don't seem to be, shifting or pivoting and still borrowing to pay out their dividends. And I'm wondering if they get back to a level, say, where you break even or better, would it be one you consider to sell, or are you going to hold them through thick and thin?
So if they cut their dividend, it would be probably a sell out of my portfolio. To your point, I see Shell and other European players. I see them really pivoting into new energy. It's not profitable yet enough. I understand that. but they are doing something. With ExxonMobil, I always have this feeling that this is a company that's more using lobbyists to influence politicians to create interesting laws for them that benefit to them. And I still feel that they have their head in the sand when it comes to climate change and such. So I don't see a strong catalyst for ExxonMobil, but for now I'm keeping it. But I think they even did again a 20 billion write-off this week. Stock price didn't really change or didn't really impact the stock price, but that's major, right? The 20 billion write-off again. So if ExxonMobil ever gets to a place where the yield is not so interesting anymore, which it was several years ago, it had a yield of 1.8 or 2%, and when it was still AAA rated company, maybe that will be ever a time, if it ever gets back there, that I would say, you know what, still no catalyst, just ditch it. For now, I'm okay. I don't want to sell really stocks when there's no dividend cut, or there must be really something fundamentally changed. And ExxonMobil is on my radar to maybe at a certain moment sell, because unlike Shell, I really don't have a feeling where it will be 10 years from now. So.
Good. Okay, nice. I think we'll move on to our main topic and discuss a little bit about Siemens.
Yeah.
So looking at them, they have a really, really cool history. 170 years old, which is quite impressive for a European company. They're headquartered in Munich, Germany, obviously. And they were founded by, excuse my pronunciation on both these, but by Werner von Siemens and Johann Georg Halske, I'm going to say. But it's a really impressive history. We don't have time to go through the whole history. I mean, 170 years will be there, but I recommend looking them up and to see it. I believe the telegraph is how they first started business. They extended or maybe invented the telegraph and kind of leveraged on from there. But they've got, for me, I think they got is a 4 or 5 main segments. And personally, myself as an engineer, I'm more familiar with the digital industries. So that's stuff like PLCs, motion control, SCADA for your nice fancy screens and stuff like that. So what kind of surprised me is how big Siemens were. I mean, I knew them from this industry only, and I knew they were a big player in that, and I compare them to the likes of ABB or to Rockwell Automations. But it was actually only when I sat down and started looking into them, how big they are actually amazed me. So within their segments, they have 71,000 in digital industries employees, 70,000 in smart infrastructure, 40,000 in mobility, and then they have this Siemens Healthineers, which I love that name, and they have 55,000 employees in that. So absolutely massive on them. I'll just quickly run through the segments that they have, just to give a slight overview. So as I said, digital industries, which is more my lane. You're talking software, factory automation, motion control, and process automation. So basically my line of work. Very, very big player, and in most machines that come in, even to my factory, or most European based, would be Siemens. Rockwell is usually, if we're getting something from the US, it'd be Rockwell, and they'd be the two biggest in my area. If you look at their smart infrastructure as well, I didn't know that they were involved in this previous actually, and you're looking at BMS systems, distribution systems, and digital grids, so your smart grids and all this. I mean, I think their core market is a 190 billion market they have there. Growth rate of about 3% over the last few years. Like, so it's a really big business, but that's one that's going to grow and grow, I think, throughout Europe. I'm not sure about European countries, but I know in Ireland we're in the process of upgrading our grid to a smart grid, and it's huge money, and we're a small country, so I could imagine undertaking this task in the likes of Germany and France that are big geographically and population wise.
But it's not only it's a smart grid, right? But think also about all the windmill parks in the northern sea around Denmark and such. And I know that Vestas is of course also investing that, but they call this typically the power socket in the sea. Yeah.
Yeah.
And this is what they're really contributing to as well. And yeah, like you said, really huge company, and I've smart infrastructure. That's where I have a little bit of familiarity with them because of my past history. And I can tell you there as well, Siemens is again one of the number one players there, together with, for instance, ABB as an example, which is also really big there. And I mean, it's just all over the place. And you know what's interesting, right? They were quite early by not just selling equipment, but also the software around it. Yeah, and I see really ABB and Siemens really strong, close competitors to this that have kind of similar qualities, similar service. And I mean, for me, this is interesting because if you see how General Electric went, then I think this is quite a success story. But this is just smart infrastructure, right? So they have also smart mobility. I think actually many of us, when they commute by train, might be sitting in a Siemens train. Yeah,
and that's crazy because you would never think that at all, because I never associate Siemens with rolling stock, I think they call them, with trains.
Yeah.
But they have they're vertically integrated there, so they actually own some of the rail infrastructure as well, which again, which was new to me. And then they have this intelligent traffic systems.
Yeah.
So
yeah, and this is huge, for instance, in the Netherlands. So what you there have is, but if you go in the Netherlands over the highway, you see like every few hundred meters, you see this all these light signals above it. So when there's a traffic jam on distance or an accident on distance, they can close some roads. All the cars straight away can adjust, and that keeps the flow going. Right? People are not surprised suddenly that there is a car standing there. In Poland, forget it. Yeah. So, and then you have all this tracking as well. So they measure your speed over a longer distance and everything. It's really smart what they're doing that. And if you think about commuting, specifically in Western Europe, is one of the biggest struggles for many people. Yeah, they lose easily half an hour to an hour a day just by standing in traffic jams. So it's really solving these problems.
Yeah. It's one thing that I can never really resonate with, because I live in a small enough city, and the commute is not, unless you live in Dublin, and Dublin in Ireland is the capital, and it's probably the only place where you'll find that problem. But everywhere else in Ireland, it's not really an issue. So in terms of the smart infrastructure or the traffic light system, we do have it in Dublin, but it's not needed. It's not needed anywhere else.
You probably still have a guy turning it manually on red and green with a candle, or not?
A little bit more advanced than that, but not too far.
But then they have also a really huge vertical called Healthineers. It was called Siemens Healthcare before. I believe they even spun it off, but they still have a majority stake there for, I don't know how much, for 70 or 80%. But again, here it is again top products, and for instance, we all know imaging. Yeah, so if you go to a hospital for X-rays or something like that, there's quite a likelihood, specifically in Europe, that you'll be again having a Siemens product scanning your body. But it's also really big in diagnostics and diagnostic solutions. And so for me, if I read this again here, it's a competitor of Roche, it's a competitor of Abbott, General Electric. So this is really interesting. I mean, I don't know such a company in Europe like Siemens, which is the General Electric of Europe, where General Electric is just a failed business, which they now are trying to turn around, and Siemens survived, and it's really interesting because I always had a feeling that in the 90s, with the CEO of GE at the time, there was this notion of thou shall have a big holding company conglomerate, and we integrate everything and such. But most of those companies have disintegrated again, and Siemens is still doing it. And you could argue because they're still growing, that is still quite successful. But at the same time, they're spinning off from time to time, purchasing from time to time. So it's never really a status quo.
Yeah. I mean, I'm really, really impressed with their three kind of pronged attack here. Like, I always associate with the digital transformation and being involved in that industry and infrastructure, but then pivoting into the healthcare and also energy, you're getting really a diversified company here. Now, I know their energy. I think they have a majority stake in the healthcare system, and a minority stake in the energy.
Yes.
And we've seen that when we look at the figures, we see a drop off because of this. But it's really impressive to see how they've done that through acquisitions and how they've grown that business. And all three segments, all three businesses seem to be successful. I know the energy is still relatively new, but I mean, they've been in that business a long time already. So I've no doubt that will be successful.
So maybe it's also good to zoom in a little bit on that, right? So if you look at 2020 and COVID-19, what it did to the company, I think to all the business units, except the digital industries business unit, margins were down. And that has quite significantly impacted their profits for this year. So it doesn't necessarily mean, let's say, that revenue was down for the business units. Yes, it was definitely, and actually, that's the interesting thing. For digital industries, the revenue was down, but the margin was quite significantly up from 17.9% to 21.7%, which means that their profit, EBITDA, still grew with like 15%, while revenue went down with 6%. This is really interesting, right? That in this part, they were able to increase their margins. But if you then look at smart infrastructure or something like that, their revenue was 2% down, but also their margin was down with almost 1%. So you see it straight away reflecting also in the profits there. Order book went also down in 2020. And I think they have still a backlog for a year, effectively, in revenue. Yeah, while before it was a little bit more than that. And then if we go to Smart Mobility, as an example again, there the revenue is 2% up, but the margin is also 2% down. So what happened? Their EBITDA, their profit also declined with almost 15%. And then to make the story complete, we have Healthineers, that kind of flat revenue, also margin down with 2%. Again, 15% down in EBITDA. So this is really interesting that it's kind of like really yin-yang, right? The digital business, margins up, revenue down, and the others, revenue flat or up and margins down. So it's a little bit yin-yang.
Yeah, and it's interesting to see like that the revenue has been growing steadily over the last 10 years until this year. COVID has obviously had a big impact. I think it's down 35%.
Yeah.
Which is quite significant, but I wouldn't imagine it'll stay there. As we see next year, I'd imagine that to pick back up where they've left off.
Yeah.
But the worryingly for me, their earnings has been declining over the last. Now I do know that they have a share buyback program that they started in 2018 and commencing the whole way through to 2021. So it might start to trickle back up next year, but it has been declining steadily over the last 5-6 years.
Yeah. Maybe what's also good to mention, right? Because we're now going a bit into the financials for our listeners. If you go now to Morningstar as an example, you will see that suddenly the revenue dropped with 30 billion. This is because of the spin-off of Siemens Energy this year. Yes. So, for instance, I think I have 16 shares in Siemens, and I think I got 4 shares of Siemens Energy or something like that. Or 8. I would need to look it up, but this is the clarification why the revenue dropped significantly. So don't be taken off guard by that.
Yeah, and that was in between 2000 fiscal year 2017 2018. It shows that huge drop.
Sorry, no, that is when you go to the Siemens webpage where they show it, because they have restated the figures. But if you go to Morningstar, you only see a difference between 2019 and 2020 because the spin-off was in 2020.
Yeah.
So and then if we look at, for instance, the free cash flow, it's actually up this year here, but this is just again, the company playing with working capital and such, stopping cost savings, stopping certain investments, and that just increases the cash flow. So it's always an easy thing to do during these times. But hey, this company is able to do it as well. Yeah, so it's still luxury, and it just shows that they have good capital discipline as a company.
Yeah, and if you look at their debt, I mean their debt to equity ratio is a little bit higher than what I like, but they're well covered by interest coverage. I think that it's over 5, nearly 6 for the interest coverage, and their debt to EBITDA is 5.44. So they're well covered in that way. They have a strong enough balance sheet that I'm not too concerned about. The credit rating as well is A+, so we know that they're quite strong.
So the only thing that I see a little bit as a red flag is that over the last 2 years, their return on invested capital, their ROIC, was lower than their weighted average cost of capital. So you could argue that they are not really adding shareholder value at the moment, because the money they borrow costs them more than the return that they get on the money. So that's kind of a loser's game at the moment. And this is really something to keep paying attention to, because if these trends keep continuing, they are just deteriorating shareholder value in the end. But yeah, let's start to talk a little bit about their dividend history, because in the end we're a dividend talk here. So one of the things we really care is about their dividend history. And yeah, what caught your attention here in their dividend history?
So first of all, they have a long payout history. I think it's over 36 years that they've been paying. It hasn't always been growing. It's sometimes been steady, and we've some peaks. But since 1987, there's been a growth rate of about 7%. You can see it was steady throughout the 80s and 90s, and then in the early 2000s it grew, and then 2009, 2010 there was a sharp increase as well. We have had a drop off this year. There was a dividend cut, but I mean, after the spin-off and with revenue slightly down with COVID, it was kind of expected, but it's back at the level of 2015, I believe. So it's not too worrying for me. It's not a big deal, and probably kind of expected if you're to anticipate the spin-off. The payout ratios is quite good. They typically aim for between 40 and 60%, which they usually achieve. This year it's 70%. But I'd imagine that'll get back to normal. But over the last 10 years, the dividend has slowed down in its growth rate. I think over the last 5 years, actually, it's grown at about 2%, maybe 2.5%. So it's not great. It's not fantastic, but it's still growth for a European company. It's still quite good.
So the issue just that I have is that I now need to replace it in the Noble 30 index, because it doesn't belong there anymore after the dividend cut. So I find it a pity, because I think they take pride out of their dividend growth history. And I believe, honestly, if I look at their balance sheet and their financials, they could have easily kept the dividend flat. I think they have done it because of also Siemens Energy spin-off. But then again, Siemens Energy is in the energy sector, which is really down. So they just decided in their first year to not pay a dividend yet. Hence, in the end, it's a dividend cut. But I think they should have just put it keep it at 3.19. This kind of like, why 10%? I mean, for me, we discussed that a little bit earlier as well. To full disclosure, I'm not selling my Siemens shares. It's still in my allocation strategy. I see it just as, like I just mentioned, a little bit stupid from the board of directors, but overall my portfolio, it has hardly an impact. I see still enough catalysts. It has a really great business model. It's everywhere. So I want to keep it in my portfolio, and I will keep adding to it. And I see it as a one-off, but if they would do it a second time, I might really change my mind and sell it. But for now, I see it through my fingers.
Yeah, but they even mention it in their annual report on one of their files that they have with that the priority is the dividend. they do have a buyback program, as I mentioned earlier, and that's there to supplement the dividend. And they state that quite clearly in that. So you're right. It probably was a silly dividend cut for them, but I mean, it wasn't anything too drastic. To me, it's not the biggest deals considering the spin-off. So what I do like about them is, I mean, they have a clear strategic plan. I mean, with the IPO for the Healthineers and the energy spin-off, and if you look on, I think it's on their business outlook or equity story, their next stage of this is ultimate value creation. So that's what they're going to be targeting next. I mean, and I have full faith in them based on what they've said and what they've done in the past. So they've fulfilled all their targets. So I have no doubt that they will achieve that.
So then the main question up in the air is then, is it now at the right price to buy? Because I think the share price is around 130, 132 at the moment, if I recall correctly.
Yeah, my issue there is it's close to an all-time high. I believe the all-time high is about 120 euro, maybe. And at the moment, it's getting quite close to that. I ran a dividend discount model offline, and look, that valued them at 191, but I don't take that in its entirety. We ran a discounted cash flow model as well, which priced it in around 113, which is what it's at now. But if you look historically at the earnings, I think the industry average is about 13, 14, and they're trading way above that. I think they're trading at 18 or 22 are actually trading at the moment. So they're overvalued from that perspective. If I was to take the average of all three of those, I get a fair value price of about $123 or €3. But I mean, I don't know. I'd rather see them around the 90, maybe between 90 and 100 before I would like to get involved in them. They seem a little bit expensive for me at the moment.
So my average cost price for Siemens is €90 for I bought 2 times a few shares. And what I've learned by following Siemens for the last 3 years, they dip regularly. So they're now, like you said, 113. I wouldn't be surprised if in January or February in the next dip, they quickly go through towards 100. What I notice with all what's happening in the energy sector and oil and gas and such, they're quite volatile from that point of view. So I think you'll get your opportunity at a 2-digit number, I think, within several months. I'm quite confident of that.
Yeah, and what I will say is if people that read my blog will know that I do stock reviews and I follow a process, and I ran that process on this and done my fundamental analysis, and they scored a 52 out of 100, which is quite low. And really that's because the earnings was down and we had all sorts with the revenue. So for me, I need to see him a little bit. If I'm to stick to my process, which I always say I do, I need to see him come down a little bit and maybe next year see a little bit of an increase in their earnings and revenue. But they're definitely a company I want to own. I want to own them because of who they are, first of all. But I really do believe in their vision and where they're going. So hopefully they'll come down to a decent price.
Yeah, I have the same. I think such a company, when you think about diversification, deserves a place in everyone's portfolio. General Electric is not an option anymore as dividend investors, so I think Siemens is a really good one. And I'm actually proud that we can one time say it, that it's a European company that is leading the industry. So maybe I'm a bit patriotic here as well.
No, I'm with you on that. It's great to have a company of that magnitude in Europe leading the charge. So I hope they do well, but I hope they drop in price and I can get them before they do well.
Exactly. Okay, I think that concludes our stock review for this week. So really interesting one. And I think we'll keep this tradition to once in a while analyze some European stocks first for ourselves, but also for the community.
Yeah, and what I liked about this one is we picked it because they've had a recent dividend cut, but it wasn't a reason not to buy them or not to consider them. Actually, the opposite. They definitely should be considered. So I think it's important, just because they've cut a dividend, it's important to see why they've done it and see how you feel about the company. So to me, this is why we've done it this week, and it was an interesting process for me, because usually they would not even make my screeners. If I was to run my metrics, they wouldn't even make the list. So it was a good exercise.
Super. So let's then go to the next session of this show, and those are the listener questions. And let me ask the first one from Centrino. With these very green days and even weeks, do you still buy at the same frequency as usual?
Yes. As soon as I get paid, I put the money in. There's always some stocks there or someone in my portfolio that's underperforming or not doing as well as they should. So I still plow ahead, business as usual.
Good.
We'll go to Danny. Danny's one next. I'll ask you this one. And he asks, what is one stock you would like or like to have invested in at their IPO if you had to choose?
I can tell you the regret, and maybe that's a good answer. I remember telling to my colleague, when was it? I don't know, 2009 or something like that, when Facebook was doing their IPO. I really don't know anymore the exact year. And I was laughing at him. I think they did an IPO of €25 or $25. And I said, like, who wants to ever have a social media stock? I mean, there's no value in it. How are they going to earn money? And he said, oh, eDGI, listen up. This stock will grow. It's so massive. It will grow. They will figure out how to earn money, because at the time they were not really earning money yet, right? From advertising or something like that. Yeah, now it's at 275, and I was laughing at him, and I bought them at 150 on average, Facebook. So this is part of my 10% part of non-dividend portfolio, but I see Facebook maybe as a potential dividend payer in the future. Yeah, and yeah, here I just look like a fool on how I spoke to my colleague. I was literally laughing at him, and he's the one laughing now because he's counting his money. I know he went really big in it, so I think he calls me the loser now when he would see me. But hey, we need to be honest about these stories, right? So
I have a similar story with Facebook. I remember at the time my friend mentioned him to me, and I was like, not a chance, no way. And I know he didn't as well, which makes it okay. But he did say to me, and he mentioned another Irish stock at the time. I think it was Bank of Ireland. They were really low, and both companies have just grown massively at the time, and we didn't get involved in either. So I like to remind him of that as well, saying, you told me about it, but you never did it. So
yeah, good. Let's go to the next one from Eloy Snowball. Apart from Unilever, which I know European DGI just increased its position in, do you guys see anything interesting at the consumer staples sector or any other sector?
yeah, in the consumer staples sector, it was Glanbia. I know I mentioned them maybe 2 podcasts ago, and they quite surprised me. So they are interesting me. I've added a small bit to them again, but they're one that I like at the moment. In terms of other sectors, I know you wrote on Twitter, and I mentioned AFLAC on that, and they're another one that I see as potentially undervalued. I saw them when they were at 35, and I said I must get to them, and I never did. And now they're at 45, but they're still undervalued, and for me, and definitely a stock to consider, especially after a 19% dividend increase recently. So yeah, there are two stocks that I'm considering.
So, and I think I saw a tweet from him that he owns them or bought some, but Ahold Delhaize also started dropping in price, and I just put a purchase order in at €22.50. So hopefully next week it gets triggered, and I will increase a little bit of my position in it again. And by the way, for everyone who speaks Spanish, please follow Eloy Snowball. He's a really great guy, lots of wisdom. I love his tweets, and he usually puts such a nice scorecard for stock on there. And I'm just so grateful that we have Google Translate, because I usually put, when I see his tweets, right mouse click, translate to English, and I get to understand what he's writing. But I would really recommend following him. Good guy.
Nice. Okay, and we have a question here from a new listener called Easy East Set, is his name. He said, "Hi guys, I'm fairly new to investing. I'm still in high school and earn €450 a month. I'm investing 300 of that every month. Are there any tools or tips that are free to analyze stocks?"
Yeah, and he mentioned, I think as well, that he has time to research now.
Mhm.
So the best tool there is to analyze a stock is called an annual report, the 10Ks, the 10Qs, the 8Ks. I would not go into how you say it. I would not really necessarily go into screeners and such. If you really have the time, taken an accounting course. I think you always mention it from Investment Talk. Pay few dollars or euros
Yeah.
for how to read an annual report and financial statements. And I would say just go really literally to the financial statements. Don't go into the annual report and all the gibberish and blah 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 from the corporates there. Go to the financial statements and analyze it from there. If you are interested in the financial health, and try to, what I always like to do is try to understand their products. So go to YouTube, read reviews about their products, try to understand if it's a consumer good, go to their shop where they sell it or something like that. Have it in your hands. Really try to get a feeling about the product. So those would be my tips if you really want to invest. And I know that €300 is really a lot for a starter. And it's actually also a lot of fun to do. So think about it like if you would like to own a part of the business. That's how you need to think about it. That would be my best tip that I can give him. And ignore all the other noise and all the other tools and such. Don't even pay for it if you are willing to put in the time of research and understanding a company.
Yeah, I agree. First of all, it's awesome. You're still in high school and being able to invest, so you're way ahead of the curve. So the good news is you have time on your hands. So spend a little bit of money, maybe educating yourself, and as you said, learn about the financial reports. Forget all the noise. Forget about the latest stocks, and or there's always time to buy them. Invest in your education, and the rest will come over time. So the last question comes from Phil. This was actually last week's question. We just missed it, so we'll ask it here. And he asked, "Do you ever take short interest into account when buying a controversial / hyped stock?"
There was a time I was looking at it, but this was more because of fear mongering online that people were mentioning it, and then I felt like, ooh, I should stay away because there's a high short interest. I stopped doing that, but I saw a nice picture of Tesla the other day, which I also tweeted or retweeted on Twitter, where it was mentioned one of the biggest short squeezes ever in history, because you saw the short interest go down and you saw the stock price shoot up. But no, I'm actually not doing it because usually I'm not buying such distressed companies. So yeah,
Cool.
simple answer.
Nice. So thanks a million to everyone for the questions again. They were good questions.
And now
So
it's your turn for the stock pick of the week, I believe. And I'm really
Yeah.
curious to which company you will bring up.
So because we're in these times at the moment with COVID, is every time I look at the news, it's always COVID and it's the talk of everywhere. I thought maybe I should look at something in hygiene. Hygiene is no doubt on everybody's lips and minds at the moment. We're in work, everyone's washing their hands 10 times a day, or if you walk past, if you sneeze, I mean, it's like you've murdered someone because everyone's looking at you kind of funny. So I was looking at stocks in that kind of area, and one that came out was Rickett Beckinshaw Group from the London Stock Exchange. So they had a very, very good year this year because of the virus. Leading up to that, they were quite poor. I know in the last maybe 3 or 4 years, revenue was down, earnings was down, but this year they've really started to take off. And the question in my mind is, will the virus spark a behavioural shift in customers? And that's really the play I'd be looking at with these. Now, first of all, it's not a recommendation to buy. It's just a company of interest, and and maybe a reason why to look into them. But if we're to believe that there will now be a behavioural shift and people will be more focused on hygiene, I think they have a really, really good chance of turning their business around. If we look at some of the highlights, so their overall growth this year on year, like for like, was 11.9%, which was quite strong. Hygiene was 16%. So they have a couple of sectors. They've got hygiene, they've got health. The hygiene grew 16% and the health grew 9%. So quite good numbers. But what I really liked about them is that they have strong e-commerce now, and that's coming on, and that grew over 60% year on year, which is quite good. And they're really spending some time now with reinvesting into their business. I think they've set aside like 2 billion to really turn this business around over the next 3 years to improve their products, to improve their online presence. So they're really going for it. What else? Their dividend yield is what, £2.77, which gives around a 64% payout ratio, which is quite good. And then the PE ratio is 18, which is around average. So for me, I'm really interested in this company, and I'd like to do a little bit more of a deep dive behind them. But I like that they're investing this money now. They've spotted the time is now. They've turned it around because of COVID, but they're trying to capitalize on it now. So it's going to be a really interesting one to watch, and I'd recommend maybe looking into it to see if they fit into your portfolio.
So I never heard of the company, and the name rings a bell, but if you say to me that they're in hygiene, I didn't really know it, and it's really interesting because it's again a European company that we're talking about, and it's amazing that we have all these kind of little jewels everywhere out there.
Yeah, you definitely know some of their products. So you have like Calgon. I have the washing machine.
Yes.
Yeah, the washing machine added. I'm singing it in my head at the moment. Dettol. That's another one of their products. Airborne. So they also actually Durex. So they own them as well.
I remember those from the early days.
and believe it or not, actually during COVID, the demand for Durex went down, and I would have believed it would have went the other way, but they had a weaker demand due to COVID.
Well, if you cannot meet your girlfriend as a teenager. But there is another question that came to my mind, and it's more of a personal question. And it's there are two radio DJs from the past in the Netherlands. They always ask this question when someone dialed in. And it was like, do you use wet toilet paper or dry toilet paper?
Wow. Dry toilet paper.
Dry. Yeah, me too. So then probably we're not using their products there.
True. Yeah, but I mean, they've on the back of the growth this year, if they can capitalize on that, I think that they want to look forward.
I think it's a great opportunity, this COVID-19, for them to just clean it all up and to set themselves up for the future again.
Yeah,
I mean, it's truly a gift for them. Good. Hey, nice choice. So you really raised the bar high for me for next week again. So I'll do my utmost best to come with an interesting stock again. But I think that concludes our show for this week again. It went really quick this time. But hey, it's always the same, right? If you're passionate about something, interesting stories, then it's just a joy to talk with you about it. So thank you.
Oh, thank you, and especially thank you again to all our listeners. We do appreciate every single one of you. I think we're growing to nearly 200 subscribers on YouTube and hit nearly 800 listens or views or downloads on our podcast channel. So I mean, it's mind blowing for us. We're just two guys chatting about what we love to do, and it's great that you're following us along for a journey. So until next week, we'll see you all soon.